Hello, this is Jürgen Herzog with Better Homes and Gardens Real Estate Best Life. I'm a real estate broker here on the Central Coast in California. And if you thought about buying a house and you're fairly new to real estate, you probably heard a lot of terms that might be a bit confusing, and especially realtors and mortgage brokers, we throw this realtor lingo around like everybody should know. So I want to go over the 25 most important terms I believe somebody that's starting to do anything in real estate should actually know and understand. I will go over the list in alphabetical order, so it's a little bit easier for you to fast forward in case you know most of the terms already. So let's get started, let's dig in. So the first term I want to explain real quick is adjustable rate mortgage. Very often you hear the term ARM and you wonder, what is that? Well, an adjustable rate mortgage is a loan in real estate in which the payments or the interest rate on your payments can change over time. So your mortgage payment might change as well. Sometimes you hear the term 3-year ARM, 7-year ARM, and that simply means that your loan is fixed. So your payments stay fixed and the interest rate stays fixed for 3 years or 7 years. And after that, it will become an adjustable mortgage. Amortization, what does that mean? Amortization is actually the process of paying back your loan. Let's say you borrow $100 and you pay it back over a given time in specific payments. That's amortization. Let's say $10 for the next 10 years, you pay the $100 back. Compared to an interest-only loan, which would just charge interest on the loan, but you're not actually paying the principal amount back. Appraisal, that's a fairly easy one, but just in case, an appraisal is actually an unbiased opinion regarding the value of a home. And it's done by licensed appraisers, and banks normally require an appraisal to be done on the property before they give you the loan, using that property as a security for their loan. And one term you hear a lot is buyer's market versus seller's market. So a buyer's market is a market, a real estate market, in which the buyer is a little bit more in the driver's seat due to the fact that there's too much housing inventory and not enough buyers. And in a buyer's market, very often prices are coming down versus a seller's market. Seller's market is a market in which there is low housing inventory and a lot of buyers fighting over those homes, and very often prices do go up sharply in a seller's market. Capital gains. Well, if you buy a house for $1,000 and you sell it later on for $10,000, you make $9,000, and that is capital gains. And very often in real estate, you will have to pay taxes on that gain. And then there is CMA, or comparative market analysis. As realtors, we use the term quite often because we cannot call our price opinion regarding a property an appraisal because we're not licensed. We're licensed real estate brokers and agents, but not licensed appraisers. But we do have a similar process. So we're trying to find comparable properties to the one we're trying to come up with a value for, and maybe adjust it for amenities and such, and with that we come up with a market value. Contingencies, that's a term we use quite often once we are in contract, under contract on a property, and it basically means certain conditions that have to be met before moving the process of buying and finalizing the transaction. And that could be, for example, appraisal contingency. So if the property is not appraised or doesn't appraise at value, you do not have to buy the house because that condition is not met yet. Closing cost. Now don't mix up closing cost with down payment. Closing costs are actually additional fees, escrow fees. On the seller side, commission to the agent is a closing cost. It can be real estate taxes, insurances, and such, all adds up to closing cost. And then there is a debt to income ratio, and lenders use that term quite a bit. They're trying to see how much debt you actually have to pay every month compared to your income every month. So the lower your debt to income ratio is, the better your chances are to get a mortgage. And then there is deed. A deed is a document and an instrument to show the transfer of ownership and the ownership itself. There's quitclaim deeds, grant deeds, all kinds of documents like that. Down payment. So down payment should not be confused with closing cost. Down payment is actually the portion of the purchase price that is not financed. So you have a house for $100,000, you get a loan for $80,000, your down payment is $20,000. Dual agency. Dual agency happens sometimes when an agent, a real estate agent, is representing not just the buyer in a transaction, but also the seller. So both parties, therefore dual agency. Earnest money deposit. Earnest money deposit is money paid by a buyer after entering in a real estate contract with the seller to show that your offer is serious. It's also called a good faith deposit, and later on, very often, it will become part of the buyer's down payment. Escrow, that is one of the most used terms, I believe, in real estate. And an escrow company is a neutral party hired by the buyers and sellers to handle all their paperwork, all the taxes, and also handle the grant deed, the document that transfers the property to the buyers. Also, the buyer's money and down payment goes into escrow. Now, the term escrow is used for a lot of things. For example, once you have an accepted offer, we all refer to it as we are in escrow, or the property is in escrow. Close of escrow is used as a term for the transaction has closed and ownership is now in the name of the buyers. Equity. Equity is the portion of your home value that is not mortgaged. Let's say you have a $100,000 home and you have a $50,000 mortgage on it, while your equity is the remaining $50,000. Fixed rate mortgage. We talked at the beginning of this video about the adjustable rate mortgage. Well, fixed rate mortgage is actually one of the more preferred mortgages because your interest rate is fixed very often for 30 years. I've seen 15-year fixed mortgages, but the mortgage interest rate does not change and therefore your payment does not change. Foreclosure is the legal process of a lender taking back a property from a buyer because they do not pay the mortgage or haven't paid the mortgage in a while. It's a little bit like a repo on a car, and in real estate it's called foreclosure. HOA, you might have heard that abbreviation. It means homeowner association, and it is basically what it says. It's an association of all the homeowners in either a neighborhood or in a condo complex and such. And with HOA, you probably have heard HOA fees. Very often condo complexes or even neighborhoods have a certain fee every homeowner is having to pay to be in that association. Pre-approval and pre-qualification. What does that mean? Well, it's a lender's term for the process of checking out some limited information of a potential borrower and approving them upon that. Very often it's income, credit report, debt ratio, and based on that they qualify you for a loan amount, but they still have to verify all that information for full approval of the loan. Principal. Earlier we talked about amortization, paying back your loan. Well, the principal portion of that payment is the money that you pay the loan amount down, while the rest of your mortgage payment is the interest payment. The term listing is used for homes that are for sale, and they should be for sale to the public, but sometimes there's something that's called a pocket listing. That is a home that is for sale but might not be advertised to the public yet. Loan modification. Again, that's more a lender's term, but if you do real estate, you might want to know what it means. It means that the lender is modifying the terms of the loan in favor of the borrower in case they have a hardship, can't make the payment. For the lender, very often that is easier to be done than foreclosing on the property. Loan to value, or LTV. That stands for the percentage you finance of your purchase price. Meaning you come up with 20% down payment out of your pocket, your LTV, your loan to value ratio, is 80%. MLS, multiple listing service. That is a database in which all homes that are for sale in a certain area are advertised on. Short sale. Well, a short sale is a sale of a property for less than the loan amount against the property. That has to be approved by the lender, and they would take a loss, but sometimes that's cheaper for them than doing foreclosure. Therefore, you should know that term as well. And that's the 25 terms I think everybody in real estate should know and feel comfortable around. If you have any more questions, or you have some terms you still don't understand, or you want to know more about it, please reach out to me or my business partner, April Whitehead, here at Better Homes and Gardens Real Estate Best Life. We're happy to help anytime. Just send us an email, call us. We're here for you.